Alrighty, how are we all today, guys? I hope you're all fantastic. It's a lovely start to February. Can't believe it's February already. That's one thing I know I can't believe. I'm not sure about you guys, but I can't believe it's already the first week of February. That January month does seem to fly past so quick. It's very, very frustrating, but we're here now, so let's make the most of it. Guys, thanks again for joining tonight. What my plan is for tonight is to just show you a few different loan setups, and I want you to understand the basics of styles of loans and loan structures, etc. This is important because next week we're going to go into resources. So that is where we go to find information about areas, properties, etc. But we've got to get this loan setup done first. So guys, I'm going to hook in now. So the first thing I want to talk about is the loan structure. That's about the security. So that's about the properties you give to the bank as a security to get the loan back. So I'm not going to talk about deposits and blah, blah, blah. I'm just going to talk about cross-securitizing your investment portfolio. It has its benefits and it does have some disadvantages as well. I do a bit of both. So it's just very important to know how it works. So the first part I wanted to go through. So if you're going out tomorrow to buy your first property, I'll start again. This is your home. I'm terribly sorry. This is your home, $800,000 the value, and you might have a loan of $300,000. Now, what the bank sees as that position is what we call your loan to value ratio. So this is your equity. This is what you own of your home, and this is the loan. So this is what you owe back to the bank. So loan to value ratio, I'm just going to shorten that just because it'll take an extra hour for tonight, because I do say loan to value ratio a lot tonight. We're going to call that LVR. So LVR up here is loan to value ratio. So if this is your home, value 800, debt of 300, your loan to value ratio, or LVR as we say, is 34.5% approximately. Oops, sorry, 37. Now, what that means is that your debt level is less than 40% of the value of your property. Now, obviously, the equity in your home is you can't sell off a bedroom, you can't sell off the pergola. So I wouldn't say it's useless, but you can't cash it in. So we need to use that equity now to start our investment portfolio. So I am talking about here with starting the investment portfolio. So what we do, we come over here to buy an investment property. Now, in the event, say for example, you buy a place for $500,000, but you need to borrow $525,000 because you're going to have stamp duty, solicitor's fees, and anything else that might pop up through the purchase as well. And if you're building, you've got to maybe allow for some construction interest as well through that process. So this by itself, you're probably looking at, by the time it's done and dusted, you're way over 100%. Now, the banks don't like to lend over 90%. So what we do is, there's two ways we do it, guys. The first one is we use this equity to come over here to buy this property. And what the bank does is they join them together. So basically you have two properties and two loans, but it's all on the one loan document, which basically means it's seen as a whole, seen as a whole picture. So what the bank does is they take your 800 over here, they add on the 525, sorry, start again, 800, and they'll add on the value over here, 500. So what it is, your value is $1.3 million of asset, okay? And then your loan side of it, so with your loans, you've got 525, you've got 300, that's about 825,000. So when you're looking at that, your combined loan to value ratio is at 64%. So before, on your investment property, you're over 100%, so the bank will say no. But if you give this property here as security, the bank will say, that's fine. As this is, of course, if you can service the debt, if your income's high enough, your loan to value ratio is at 64%, which is well within our parameters and the policy of our bank. And we will give you 105% of your investment property, as long as you give us security of your property here. Now, doing it this way, it has to be most times, 99% of times, the same bank. So this is lender A, and this is lender A. Now, the downside to that, a lot of people say, I don't want to lose my house. Now,
for you to be in a position where the bank's actually contacting you to basically lose your house, you haven't been communicating. Like I say to all my members, if you have a financial difficult moment, call me straight away and let's strategize what to do with the bank and how to approach the bank to deal with it. So in this scenario here, if you ignore the bank, what they can do is they can actually choose which property they want to sell. Now, this is a very, very worst case scenario, but they'll choose which property they want to sell. So your home might sell quicker. So they'll flick this before they sell your investment property. But for those of you who are nervous about this structure, and I would probably say 90% of our members have this structure, because to be in a bad position and to ignore the bank is the wrong thing to do anyway. You just basically sell this property before the bank does if you do have a problem. But the way we get around that for people who are very, very nervous for that is we do it a little bit different. So this is basically the most common way, you would say. But the way we do it differently is, bear with me guys with my fantastic eraser, is what we do, a couple of things different. So over here, initially, we have a $300,000 loan. So what we want to do here is we want to borrow in a separate loan. If it's for investment, make sure it's separate to your home loan. 20% deposit plus all your costs. So that's about $125,000 we're going to borrow from lender A, right? Then over here, lender B, we've already got our deposit from here. So we're going to take this deposit, pop it in here, and we're going to go to lender B and borrow this $400,000. What this does is it forms a straight line. These are not the same bank, all right? So be careful not to use the same bank that has the same funding. Say, for example, Rams and St. George are Westpac. So you want to make sure if you do want to do this structure, use a totally different bank. But doing it this way, totally separate, and in the event that you can't pay the loan, that you're in a position of financial difficulty and the bank's not listening, etc., you have control over which loan you're going to pay. So you'd stop paying this one, let that lender take that one, and you keep your home. Obviously, that's a really worst case scenario, and I've never had that happen, but that's the way you can do it. So this is what we call an uncross securitized loan with two separate lenders. That is just there for people who are very nervous about using their equity in their own home. Now, the only downside to this structure is if you're with lender A and lender B, this property rises in value and your investment property rises in value. For you to get your second investment or your third property as a whole, it's a little bit more difficult to borrow the deposits, etc., because you've got to go to this lender, you've got to come back to this lender, and it gets a little bit complicated. And for some of my members who did start out like this, and because it was their first property, it's always very daunting buying your first property. After a few years, we've actually changed it back to be under the same lender. Two reasons. One is easier with paperwork, and two, you can normally get a better discount with your bank if you have all your lending with them. Now, that's a big one. Now, there is a couple of banks out there that make us do this separate security structure under the same bank. Now, personally, I think that's a total waste of time because the bank still has an all monies clause in the contracts, which means they can sell either or. So if you are going to do this structure, always make sure you go to a totally different lender and just make sure the funding isn't from the same lender, because you want to make sure you have full control over that structure. So this is about cross security and a safer way of doing it if you are a little bit of a nervous Nancy buying your first property. Sorry to call you a Nancy, by the way. That's a bad way of saying it. So what we've got here, so let's just clear my board up, sorry guys. So that's just about loan structure, okay? That's not going to save you any money, but that's just loan structure. I like to just briefly touch on that. So the next one I'm going to go through is just two different main, you could say, types of loans. So repayment wise. So say, for example, best way of doing it, this is interest only versus principal and interest. So a lot of people don't know what interest only is. A lot of people quite funnily call it interest free because they get mucked up with the old Harvey Norman cards, but this is interest only. So what we're paying here is just the interest. We're not paying any principal. So principal is the traditional style home loan where you're paying the debt down. With the interest only loan, interest only. If you borrow $500,000, a normal interest only period, traditionally, this is traditionally, because just remember guys, this is general information. Do not go out and take this on without getting independent advice. $500,000 loan, in 5 years time, you're still going to owe $500,000. But these structures used very commonly. A lot of accountants will advise you to do this structure. And what you're relying on, you are relying on the property rising in value, okay? But it's keeping the cost down of your investment portfolio. It's like a business. An investment property is like a business, and you have to make sure you treat it like a business. So that's interest only. But then you've got your principal and interest. Now, this is your traditional style loan. So this is interest only 5 years. That's fine. And then you've got to refinance and keep going with every 5-year period. With principal and interest, you might borrow 500 here. And of course, in 30 years time, you go down to zero, because that's the traditional home loan style. So, but the difference is the repayments, okay? So interest only, this property is going to cost you $500 per week in repayments. Principal and interest, the property here, it's going to cost you $700. So most accountants will tell you, if you've got an additional $200 spare to pay off this investment property and you still have debt on your home. So if you don't have debt on your home, this doesn't matter. You still got home debt. This debt here is tax deductible. So most accountants will probably advise you to take that extra $200, go back to interest only, take that $200 and pay it off your home loan, because your home loans are not tax deductible where these property loans are. Some people like principal and interest loans. They just like having a principal interest loan to see the debt coming down. That's fine. It's not a perfect world. This structure doesn't suit everybody. You've got to be comfortable with your investment choice and the decisions you make. But most accountants would prefer that you don't do that. It's like, for example, me personally, when I get a lease for a car, my accountant, I'm not sure if he's 100% happy with the way I try and get my lease down quickly. I have bigger repayments. That's more of a security thing for me. But that's more of a business style sort of things, because cars are a depreciating asset where a house is an appreciating asset. So it's going to go up in value. So that's interest only. And this is what we call principal and interest, so paying the debt off. So depending on where you're financially at the moment would depend on what structure you take. All righty, guys. Now, just don't forget, guys, do you have any questions? Do you have any questions out there? It doesn't have to be related to tonight, because if it's not related to what I'm talking about today, I'll answer them at the end, like we do every other week. So, all righty. So the next part is, so we've gone through how to cross securitize to get started. So you don't need a deposit for an investment property to get started. If you have your own home, you can use the equity. Of course, if you don't have your own home, you do need a deposit. And then we've gone interest only or principal and interest. And that will also come down to whether you're rent vesting or whether you own your home, or whether you have a fairly large mortgage and you're buying an investment property and you really want to keep the investment property running as lean as possible, okay? So the next one is fixed and variable style loans. So I'm going to go through variable first. So with variable, simple. Variable, you can basically do relatively anything you want with it, okay? The problem with variable though is it's susceptible to interest rate rises. So at the current climate, where interest rates are low, they're quite consistently low, but who knows? Next reserve, like the Reserve Bank today said, leaving interest rates the way they are. So next month, they might put them up 0.25%, 0.15, 0.1. I don't believe they will, but you know, they might put them up if the inflation index has gone up quite considerably. The Reserve Bank might decide to put up their interest rates. And just remember, what we've seen over the last few years is banks acting not in line with the Reserve Bank. They've got this confidence that they can do whatever they want. So Reserve Bank to me is, I'm not sure what it's there for anymore from a bank's perspective. So that's the variable rate, do whatever you want. So then we go to a fixed rate. Okay, so with a fixed rate, that is good for investments, depending on your loan structures. A fixed rate has the benefit with a fixed rate is that you have this security. So if you do a fixed rate for 3 years, 5 years, 2 years, or 1 year, whatever you want to do, you have a full security of your repayments are not going to change through that period. Now, there are downsides to having a fixed rate. You have the luxury of having secure payments every month without fail. But if you sell the property and you want to pay out the loan, you have a problem where the bank will charge you exit fees or break costs. And the bank won't actually tell you exactly what that'll be until the day. But you can get a guide, of course. But what that can be huge. Do you know what I mean? Like that can be 20 grand, 30 grand, 10 grand, 5 grand. Depends on your loan size and how long you've got left. And depends on what you bought your money at, and depends on what the bank bought their money at. They basically charge you the economic loss on the remaining term of your loan. So you've got to be fully aware of that. A lot of people understand redraw. So if you're in advance, so if you paid additional payments off your loan, you can redraw it. A lot of fixed rate loans, you can't do that. Some you can, but most of them you can't. You can't have an offset account, which I'll talk about later. A lot of them you can't do construction either. So a lot of our members do construction, and a fixed rate just doesn't going to work. There is 1 or 2 lenders who are basically the opposite of what I'm saying, but the most common practice is, fixed rates are great for security, but they're a little bit restrictive depending on what you want to do moving forward. Especially if you've got one property, you go to buy a second investment property, and lender A says no, but lender B says yes, you have to break that loan, refinance to be able to get that next property in place. And that might not be worthwhile. Okay, so it's variable and fixed. What I want to talk about now is variable and fixed rates. Most people understand, but a lot of people don't realize the fixed rate does come with a lot of restrictions to it. And the element that there is that potential of a break fee as well. So, but when you do get your loan in place, you want to make sure you have a good product. Now, as an investor, there's 2 sort of main products. Just take fixed out of it for now, but the 2 main products is what we call a basic loan, or in the old days, makes me feel old, we used to call it a no frills. So what a basic loan is variable, it's not fixed. A basic loan are very restrictive in the fact that sometimes you can't have offset accounts, sometimes you don't have redraw, sometimes you can't cross securitize, sometimes you can't split it and do a fixed rate. So, but a basic variable rate is normally quite cheap. And on top of that, it has no fees, normally pretty much no fees whatsoever, depending on the bank. So, but if you're a property investor, you will normally want to have multiple loans, multiple products. You might want a credit card with that. So what we always suggest to really consider is what we call a package loan. So a package loan is a bit more like, we call it an umbrella, okay? A package loan does come with a package fee. So a package fee will normally be around $350, say $400 per annum. And off the record, which is not really on Facebook, you can sometimes negotiate that as well once you become a customer. But with a package loan, what it does is this money here, which is $350, $400 per annum, it covers you for everything. So it covers you for up to 10 loans. It might cover you up to numerous savings accounts, credit cards. But a good thing about the package loan, if you've got a package loan with a couple of multiple products underneath that umbrella, you can normally negotiate an interest rate in a lot of cases cheaper than a basic loan. So you have the added advantage of having multiple products without any fees. That's a credit card included, even though everyone knows I really don't like credit cards. But you have that product for $400, $350 a year. You don't have any more fees, no application fees, basically pretty much zero. You may get the occasional like $100 additional security fee, but of course your government fees, like your registration of your mortgage, etc., do not come under that package. That's a government fee that the banks pass on to you. So basic's good, but basic's more for me is, say for example, you're not an investor and you might have $150,000 left owing on your loan. You're 55, 60 years old and you just want to smash down that loan, get as many repayments in there as possible. That's the sort of basic product you should be going for, rather than having the package, because a $150,000 loan doesn't, this fee, it's just not worthwhile. So, but a basic product can get your interest rate lower than a package loan if you have a small loan and your only objective is to get that paid off. So package loans are good. A lot of people complain about this package fee. A lot of people do. Now, me personally, I pay 2 package fees for 2 separate banks. But I'm fine with that because I know I'm covered and I know I can negotiate rates through that structure. You can't negotiate rates most times with a basic loan. All right, guys. All right, so that's professional packages. I just wanted to mention about professional packages because they are a good product, especially if you're splitting up your loan, even if it's just your home loan. If you've got a home loan over $350,000, you might want to split some of it and do say 250 fixed and 100 variable. That's where the professional package works really well. Most fixed rates will come with at least a 0.15% discount, and the variable rate, we can get up to, in some cases, up to 2% discount off the variable rate, depending on your loan size, of course. But that's what a good mortgage broker will do for you, is they'll try and assist you in getting the best product, but then also negotiate with that lender to get an additional discount to what the carded rate is. That's very important. You have the best products available for you and also the best interest rate as well. So it's fixed variable package. Okay. Offset accounts. An offset account is a very good product with property investment. It works better for you if you have additional money like cash, etc. But I'm going to break it up for you just so you understand what I mean, because when you go from a mum and dad investor to say a professional investor, you might have a bit of additional cash laying around for a month or two in between opportunities, and an offset account's a perfect place to put it. So best way of showing you, I'm going to build another house here, and let's just say you owe $500,000. Okay, actually this is not a house, this is just a loan. $500,000 loan. Now if you have a $500,000 loan, interest, if you had an interest only 5%, it's going to cost you, sorry, I do have figures behind there so I don't make a mistake. It's going to cost you $2,080 per month. Now, say for example, the best one is, and probably the most common one for a mum and dad investor is an inheritance. So say for example, you receive an inheritance of $100,000, which is fantastic. And just say for example, you own your home. So you want to really pay down other forms of debt, but you still want it accessible in case you need to upgrade your car, pay for kids' braces or whatever it might be. You've got 2 options. One option, the ATO or the Australian Tax Office doesn't like and your accountant really won't like. The other option is the better option. So if you had $100,000, you could just pop it in here and then you would owe $400,000, right? Simple, yeah? But this $100,000 you whacked in here, if you need to, this is an investment loan as well, by the way. I better make sure I clarify that for you. Investment. This $100,000 of additional money you popped in here to save on some interest, which works fantastic. If you need this money and you need to redraw or take some back out for a car or something personal, not investment, you have mucked up the clarity of the tax deductibility of this loan. There's a huge grey area there, and the Australian Tax Office is very critical on this. So the problem with that $100,000 is that if you do pull it out and you do claim interest as a tax deduction on that 100, you can get yourself in a bit of a pickle. So what we want to do is we want to set up what we call an offset account. So we don't put the 100 here. What we do is we set up an offset account. Now an offset account is a generic, simple savings account, everyday account. You can do whatever you want with it. The only thing it is it's a nominated offset account to this loan. All right, that's it. Some people think they have an offset account, but realize the loan and the offset account aren't connected. And that's where you just have to have a quick call to your bank. They might send you a form, quickly sign it, whack it back. So if you put your $100,000 over here, the difference is your repayments were $2,080. Having $100,000 over here in your offset account, your repayments are now $1,680. So you're actually saving $400 on a monthly basis. So that's $100 a week, $5 grand a year. So But the benefit is you haven't put the money into this loan. This has one account number and this has a different account number. So with that $100,000, your accountant's going to love me for this. If you wanted to pull this entire $100,000 out, this loan is still tax deductible up to the $500,000. Okay, so offset accounts work fantastic. You can have direct debits, your pay go in, your rent go in, everything work for you. Very often we throw the rent, we do pass the rent through here before the repayments come out, because every little bit of dollar you have in this offset account is saving interest on your investment loan over here. If you have a home loan, of course, offset accounts work just as good. It doesn't have the restriction that you've got to be careful of with the investment loan, but it's good to throw all your money into an offset account, have that offset against your mortgage, and you're saving interest and interest. And when you compound interest savings, it can be quite dramatic over the big picture. So an offset account works fantastic, but that's how we would use it on an investment portfolio or just an investment property. Now, some banks will only let you have one offset account for one loan. Other banks will let you have up to 10 offset accounts for one loan or up to 10 offset accounts for 10 loans. So depending on the lender and depending on that, this all comes down to that package, the professional package style loan I mentioned before. You can have a good loan structure and have the offset account, have multiple offset accounts all working for you. Because when you get into professional investment, if that's where you want to be, you might have additional money put aside waiting for something to come out of council. You're best to offset other forms of debt. Otherwise, the money's just sitting there, dead money doing nothing. Money in a bank in the current climate where interest rates are just absolutely ridiculous, just not going to work. So I do have a question in here. Okay, so Scott's asked a question, how long can you go interest only before going to principal and interest? So Scott, to answer your question, the most common is 5 years for interest only. You can do less. You can do 3 years, 2 years, 4 years of interest only, whatever you want. And it does revert then into a principal and interest repayment. After 5 years, if you decide, listen, I want to go interest only again, we used to be able to do like a short form, but with more recently with the banks being a little bit stricter, you do have to reapply. So you would normally get a letter 3 months out from your bank saying your interest only is going to principal and interest. So you've got time to review everything to see what you want to do. Hope that answers okay there, Scott. Alrighty, guys, bear with me. A bit slow on that one there today. Okay. So the next part I want to talk about is interest rates. So a lot of people don't realize, I'm seeing this a lot lately, they don't realize that interest rates are different depending on your risk. So best way for me to explain it is there's 3 or 4 different tiers of interest rate. A owner-occupied rate, so a home you're going to move into and live, is normally a lower interest rate compared to an investment property, okay? And an interest-only interest rate is also different to a principal and interest rate. So what I'm going to talk about here is purely investment, nothing about owner-occupied, but there's 3 or 4 different tiers, which we've got levels, I suppose you'd call it, is if you go out tomorrow and borrow 90%, so you're borrowing a fair mint, your class is what we call a high risk. So the bank's going to put a high interest rate on that. And say, for example, we went interest only at 90%, you might pay in today's market 3.5%, okay? Then and as you go down, so you've got 80%, 70%, and normally 60% is the bottom. Some banks tier them right down to 60%, and some banks only tier the rate to 80%. So depending on the bank, they'll see you at a different risk. So interest only, 3.5 at 90%, but you can sometimes at 60% if you wanted to pay principal and interest, which as I said before, it's totally up to you guys. You might only have a rate of 2.5%. So that's a 1% saving. Now, the only thing is this repayment up here might be say $400 a week, but even if you are paying principal and interest down here at 2.5%, you're still going to have a repayment of like $550, $590 per week. So a lot of people feel as if a 3.5% interest only and a 2.5% principal and interest, the repayments would be the same, but there still is a fair bit of difference even though this interest rate's lower, okay? So depending on your financial structure, it would be depending upon what advice you'd be given on what level, what loan, because if you lock into a 60% low rate, you might be restricted to borrowing up to 90% if you want to extend your portfolio. So you've got to think of today, but you also have to think of what your future plans are going to be, because you don't want to impact that. Because when you put a loan in place, it's a 30-year product in most cases. And don't get me wrong, the average loan's refinanced every 7 years, but you want to make sure the next 3 to 5 years is pretty rock solid with your loan structure, with what you want to do. I don't like refinancing people away, but depends on the reason. Sometimes we just have to do it to make it all work. Okay, guys. So tiering the interest rates will depend on the bank, and also depend on what risk the bank sees you at. So a lot of what we call non-conforming lenders, which is basically if you've had problems with your finances in your past, they won't even give you an interest rate until you submit your application, and who knows where it might end up. Obviously, you're not obligated to that, but that's what they do. They actually price your interest rate on your risk level. It's a bit like commercial. They will also price your interest rate on your risk, definitely there. So, and because we're talking about loans, I just want to touch base on major banks versus non-bank lenders. So I don't really have to write nothing for that, but with major banks depends on what your loan size is. Major banks in the present market are quite open, but also non-bank lenders can be as well. And I'm a big one. You have to mix it up. So once your portfolio gets to a certain size, you really don't want to have all your properties, like the security, your properties and loans with one bank, even though you will get additional discounts, but it gets to a point where your discounts max out and the bank won't give you any more discount. And that's where you're basically, the way they see it is that they've got too much risk with you. And that's when you go to another lender. So not the whole lot, I'm not saying the whole lot, you start using another lender. That's why I pay 2 package fees, because I use 2 different banks. Okay. So the good part about major banks is they have branch access if that's what you want. If you've got cash, if you've got a business as well, sometimes you want to have your business banking the same as your home banking. I don't recommend that. I always try and keep it separate. But if you do have it the same, it's having that branch access is good. Putting cash in, internet banking. I do feel as if internet banking could be a little bit more secure on the major banks, even though I recently had an issue with a card. I do believe security feels more secure. Your total loan amounts will probably be higher on what they'll lend you, because a lot of banks have a limit to what they'll actually lend you. And the flexibility is quite open there as well. Non-bank lenders are good though, because even though they might not be great, now, a non-bank lender necessarily isn't just an internet-based lender. Some of them have branch access as well, like the Newcastle Permanent, for example, Bank of Queensland, but they might not have branches everywhere. That's what I'm trying to mean by that. The total loan amounts will probably be less, and as a whole, and they will have sometimes what we call restrictions on the style of property you're buying and also the postcode you're buying in. So say, for example, you can go and buy like a dual key property. Some banks don't like them, so they won't give you the money for that security. Some postcodes have restrictions, especially, I'm not just talking about dodgy areas as far as restrictions. In tough times, like your studio apartment in capital cities, less than 50 or 40 square meters, they actually won't lend on. They won't give you any cash on, where the major banks might. Another one is bigger properties. So I'm talking acres of properties. So if you want to borrow, say, 80% on 100 acres, that can also be very limited to who will give you that money, because 100 acres is normally situated potentially in a more remote area as well. So therefore you go from, once your land gets too big, you get to a point where you go from residential lending to commercial or business style banking as well. So that's where we come down to it. All right, guys. So I'm for major banks and also for non-bank lenders, but you really got to make sure you've got the right bank for you, who you're going to grow with. So you might be great. Don't want to be with a big major 4, but if your scenario is a little bit different and a little bit tight, you might have to be with a big bank to be able to grow yourself, to get yourself into a better financial position. Just remember, we all hate the banks in some sort of way. Most banks have done something wrong by us. We cranky at them for something, but we use them as a tool. So use them as a stepping stone to get yourself ahead financially, guys. Banks are there for a reason. We use them, but you've just got to be safe and secure and invest within your comfort zones and your risk profile. Guys, thanks again for watching tonight. Now, do we have any questions before we go? So any more questions? And it was really good. I love seeing questions in the group. I might not see them straight away, of course. I'm not sitting on Facebook every minute of my life, even though some people think I do. But I can pop in there, answer your question the way I think. Worst case, of course, Jess has popped in. Actually, yeah, Jess has popped in here now. The 15-minute chat. If you have a question that you really don't want to expose to everyone else, feel free. 15-minute non-obligational chat. Just book it in. It pops up in my calendar. I'll give you a quick call, and we'll just go through it quickly over a 15-minute chat. So, guys, don't miss next week. Next Tuesday, 7:30 Australian Daylight Savings Time, not Brisbane time or Adelaide time, etc. Daylight savings time, I'm going to be talking about resources. So I'm going to be talking about probably 8 to 10 different places you can go to get information to help you make decisions on areas and different styles of property. Thanks again, guys. And I really look forward to seeing you again next week. And if you have any questions, put them in the comments. No problems. I'll see them later. Otherwise, send me a message on Facebook, whatever. Just reach out. Happy to help. All right, guys. Thanks again. I look forward to chatting to you soon.